Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here, Private Lenders Podcast. Thank you for checking out the show. Today we are talking about Alex Hormozi's new book that's coming out and how this concept applies to private lending. In case you aren't familiar, Hormozi, he's really blown up in the past few years, 3-4 years. Alex Hormozi, if you aren't familiar with him, go check him out on social. He's putting out some of the best general business content out there. If you want the very specifics of private lending, that's right here on the show. If you want some general business, Hormozi's a great option. And he's about to put out his third book called $100 Million Money Models. And so what that is talking about is basically business models, and more specifically the business model and how you charge your customers, when you charge your customers, like which models work and which are kind of destined to flop. Does that make sense? And a lot of it has to do with some upfront money. And we're going to dive into that related to his examples from the podcast and then also private lending.
Yeah. Every time I listen to some of his podcasts related to this, it's so relatable to our lending company, our lending operation, and how good the lending business is compared to so many other businesses, especially just because, each sale or each loan equals a lot of money. And a lot of them turn into repeat borrowers over and over and over.
Yeah.
And imagine if you're selling some widget and it costs $50 and you got to spend a lot of time to acquire them, to acquire the client and nurture the client, and you're making like $50. And then, maybe they're on a retention and continuity program and they come back to you. But like having the ability to be in a business model that you get paid a lot per transaction, and it's actually an investment vehicle as well, is just so beneficial. So I'll give you a quick example of a money model in general, just to kind of think through, and then we'll talk about the private lending ones, the hard money lending ones, because that's when the magic happens. But like one of the examples that he used was like the gym world, gym memberships, because that's what his background was to begin with. And think about it. Think about any gym. Let's say it's an expensive gym. It's like $100 a month. Keep in mind, like if you have a $100 a month product and, you have to, offline, solicit members to come in, get paid traffic to come in, like that's hard for $100, right? Like for anyone that's doing paid advertising right now, social media, paid advertising, Google AdWords and things like that. Like if your back end product is only like $100, like it's going to take you months and months, maybe even a year to recoup the cost of that, right? Like, hey, in a perfect world, I'm going to put $50 into an ad and I'm going to get a $100 client, right? And I'm good. And I can just go all in on that. But it doesn't necessarily work like that on a low ticket item. So one of the things that Hormozi's kind of notoriously done is figuring out, I can't remember what the term was, a self-contained offer, self-fulfilled offer. I don't remember what exactly. We learned this a long time ago, not from him, from
Self-liquidating.
Self-liquidating offer.
That's what Russell used to say.
But in essence, what a self-liquidating offer means is you can break even, if not make money on the front end during the acquisition of the client.
Let's do it.
Where if you can do that, then you can just put endless amounts of money towards acquiring new clients. And for selling a gym membership for $100, like it's just not going to be a self-liquidating offer. It'd be hard to do. So what, Hormozi was notorious of doing is adding means to make more money on the front end from the client. So I'll give you an example of something that he does. And he talks about this, and you can kind of relate this to the lending side as well. Like he would do weight loss challenges. So for instance, when he does paid ads to get somebody in the front door to sign up for the gym membership, oh, hey, we have a $500 weight loss challenge, it costs $500. It's a 6-month program. You get whatever, you get 6 months of your membership for free, to be built into that. And then all of a sudden it's okay. Now I don't have $100 that's going to cost me to acquire a client. I give up to $500 to acquire a client. Right. And then, there's additional upsells or ascension offers where, okay, well, through this weight loss program, you also need supplements, and then you need this, next thing you know, your cost per, you're not, you look at your cost per acquisition, but then you look at your actual, revenue that you're bringing in per acquisition, and it's significantly more than what your costs were. And then if you have that kind of locked in and tied in, okay, well, everyone else has $100 a month to acquire a client. Now I have $500 or per client. They have $100 per ad to acquire a client. Now I can spend up to $400, $500, $600 to acquire a client. And whoever has the bigger, the most amount of budget to acquire a client is going to win. So let's relate this to lending, because each client that we all acquire as a lender pays out thousands of dollars.
Yeah, I want to do a couple examples over on the real estate side to really illustrate this point and how, and that when I listened to that this morning, that really was my main takeaway, is that our business model is great according to what Hormozi is describing right now. So like, if you think about, say, a property manager, they take on a unit or a multi-unit building, and they make like $100 to $200 a month per property. There's no big upfront hit, right? You're dealing with, obviously tenants, rent payments, repairs, maybe evictions, all that stuff. And there's no big upfront. There's no big fee coming down the road. It just isn't in that model. When we're talking about private lending, we get it both upfront and residual. So upfront, if we're doing average loan amounts, 200, 300K, like for the longest time, we've used the $10,000 number as average profit for a private loan, a hard money loan in our market, but it's higher than that, to be honest. Like that's really on the pessimistic side, $10,000 net, especially if you're lending your own money, then it's double that. But let's just use $10,000 there. And a good chunk of that is going to come in upfront. So it's not necessarily day one when you acquire a customer, because you might get a phone call from somebody today who needs a loan. It's going to close in a week or two. So it's not immediate, like somebody buying something online, but it's quick. Our sales cycle in this is quick, because people need to close investment real estate deals fast. And then each month we're going to have that residual income, because if we're using investor capital, the typical setup is that they're getting 80%, we're getting 20%. We get 20% of every payment that comes in the door. When you have a bunch of loans outstanding, that gets very big, very fast. So we have both the good upfront hit and then also the residual. And you could also compare that to regular mortgage lending, whether you're doing investment property, conventional homeowner stuff, whatever it might be. In that position, there isn't an ongoing thing. Anybody who's in that business, whether they're, running a small company or operating a branch, or they're a loan officer, you're making, like, each month you're back to zero, right? Each month you're starting over, and you make commissions on which loans you close that month. It averages between, half a point and a point. So if you're doing $500,000 primary residence mortgages, you're making it between $2,500 and $5,000 per deal, and there's no residual. So like, it leaves a little bit to be desired compared to the private lending model, because we get both the upfront good amount of money, and also I want to break it down to cost to acquire. So we've been using this example as we've been talking a lot about paid traffic, which our buddy Shane's been running for us for the past year, and it's working really well. He's working with some other people in the Mastermind group now too. And it looks like we're about, give or take, again, just to use round numbers, about $100 per loan application using paid traffic, which is okay, because how much can we spend in order to close a deal? We could spend up to $10,000, because we know we're going to get that at the time of closing, or shortly after. So that's 100 loan apps at $100. How many do you think you're actually going to close out of 100? Way more than one. It's not going to be like 50 or 60. It's just not the way the numbers work. But you're going to close a few, and you're going to get 3, 5, 10x your ad spend, which is not the case in so many business models, so many money models, which is why it makes so much sense to run paid traffic in a high ticket fee business like ours. That was a rant. That was a long one, but I wanted to get that all out.
Well, and I'm still so surprised that nobody, I don't want to say nobody, but like a lot of lenders we talk to in the Mastermind group, they just don't take the marketing side as serious as other parts of this business. And this whole game is just bringing in good loan opportunities to do deals. It just is. And whoever has the most loan opportunities is going to do the better deals. And whoever can pay the most for those loan opportunities is going to do even better deals, because they can continue to do more and more and more. I mean, if you were to start any business, like in general, like what do you put towards your marketing budget? What percent? Guaranteed you're not doing that in your lending company. So many people aren't. And to be honest, we probably don't even put in as much. Our size operation, like we probably should be spending significantly more on marketing than we even are. So like it's a good thing. Hormozi's a good, kind of daily reminder of some of these things. And his full book isn't out. This example that we gave was from a podcast episode teaser related to it. So I've read his first 2 books. I'm certainly going to read this book. And we're always thinking of ways, because listen, in a perfect world, it's great if you can break even on the front end, right? Or make money on the front end. Like, hey, I put $1,000 in, I get $2,000 out. Cool. Now I put $2,000 in, I get $4,000 out. Like, that's the dream, right? Put $1 in, get $1, $2 out, $10 out. That's the, to figure out that. And it's not forever, right? There's not unlimited deals in your one jurisdiction, right? You might need to expand in other markets and things like that, but you get the point. And Hormozi understands these models, and this concept we get as well, and I'm looking forward to hearing some of the other ones that he's using, because we're always looking for an edge over our competition, and we're always looking for ways to acquire new clients, better clients, more clients, and just do more deals, better deals. That's the game. Be more profitable.
That is the game. And you're right. I mean, it does start with proper ad spend, marketing. It just makes it so easy in our business. Like everyone knows we talk about marketing a lot because it's important. Like when we hear people from the Mastermind take a look at some of our sample deals and be like, God, how'd you get a deal this good? The answer is just marketing. It's all it is, right? Bring in a lot of opportunities, quoting confidently the way that we want to in terms of the rate and points, and also the leverage, of course, and then taking care of our people, and then having good clients that we want to come back. They know what they're going to get. And I was talking about this on LinkedIn recently. Like we charge $12.99, and 3, we're known for having borrowers bring a good amount of cash to closing, which is, not all lenders do that. Not all borrowers want that, but that's our game, right? And that's how we turn, the right amount of profit and risk, right? Like risk adjusted return is where we want it. And we don't have to do 100 loans a month, right? That's one of the great things about this model too. It doesn't require 100 units a month out of a 10-person team. And that's great. Yeah, just wanted to get that out there. I'm feeling that, as this book comes out and we keep hitting those Hormozi podcasts, we're going to bring up some of his topics, that the ones that really apply to the private lending model. I think that's going to come up more and more. So with that, if you haven't done so already, come join us at hardmoneymastermind.com, where many, many members we have seen go from a small operation to 10 million, 15 million outstanding, all private money. It's very repeatable. You can definitely learn from the others and from us. We'll see you inside hardmoneymastermind.com, and we will catch you here next time on the podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.